Hello, everyone, and welcome to today's webinar, Private Equity Investing 101, an overview for new investors. Before we get started, I would like to go over a few items so you know how to participate in today's event. We've taken a screenshot of an example of the attendee interface. You should see something that looks like this on your own computer desktop in the upper right corner. When you join today's webinar, you selected to join either by phone call or computer audio. If for any reason you'd like to change your selection, you can do so by accessing your audio pane in your control panel. You will have the opportunity to submit text questions to today's presenter by typing your questions into the questions pane of the control panel. You may send in your questions at any time. We will collect these and address them during the Q&A session at the end of today's presentation. Any questions not addressed during today's webinar will be answered via email. Today's presentation is available for download in the handout pane of your control panel. You may download at any time during the presentation. I would now like to introduce Alan Latta, the Managing Director of Campton Private Equity Advisor.
Hello, everybody, and welcome to the webinar. We have a good group here today, and I'm going to show my face here for a few minutes with the webcam so you can see us. In the background, we have downtown San Francisco, and actually that's the base of the Transamerica Pyramid behind me. Here is the legal disclosure screen. I started my career as a private equity attorney, so you would expect me to have something like this. A few thoughts on Campton Private Equity Advisors. Let's see, I'm having some screen issues here. Campton advises their clients on their private equity investment programs. We work with a broad range of clients, and we have a wide variety of advisory services we offer. And a little bit about me. I have been in and around private equity for a long time, and I'm excited to be presenting to you today. So with that, we're going to jump into a poll, and I'm also going to turn off the webcam so you have a little more room on your screen. But the first poll question is, how much experience do you have with private equity investing? None, fund investing experience only, direct or co-investing experience only, or fund and direct and co-investing experience. So please mark your answer and submit, and we will go to those responses right around now. So here are the results. So some of you have both fund investing experience and fund and direct, but about half the audience has no experience, so great. We'll move back to the presentation now, and we will dive in. So let's see, so private equity. What is private equity? Well, private equity, the term private equity is used in different contexts. And so it might mean something different depending on the context in which it's used. So the two I want to highlight are really private equity is when it's used to define an asset class. And what that means is when an investor is talking about their private equity investment program, it usually means that it includes buyouts, growth equity, venture capital. It may include other strategies, private credit, and some other strategies. But you're using the term in that context as an asset class. Another use is when you're describing a firm. And you may say, somebody may say, I work for a private equity firm, or you're investing in a private equity fund. Those typically refer to buyouts. So if you go to a website and they say they're a private equity firm, it generally means that they invest in buyouts. Venture capital is a distinct strategy within the private equity asset class, and so typically, if it's a venture capital firm, it'll refer to itself as a venture capital firm. So the first thing to know about private equity is, to understand that it is used in different contexts and it may mean different things depending on the situation. Okay, so when we talk about the private equity asset class, as I mentioned, it usually includes a variety of different strategies. Here are kind of the main strategies. We're going to talk today about buyouts and venture capital. So diving into venture capital, when I think about venture capital, I like to think about it in two ways. What are the characteristics of a company and what are the characteristics of an investment in that company? So here we're going to talk about early stage venture capital. And early stage venture capital, a company is very new. It can be a true startup. Early in its development, it may have no revenues and very significant negative cash flows. These companies are all privately held. And the company is usually formed to address a huge opportunity. That can be a market opportunity or that they've developed some technology and they believe that it has huge potential. But these companies are very unproven. It's an unproven technology, could be an unproven business model. Sometimes management is very young and unproven. So it's a very early and unproven company that needs to prove itself over time. Most of the companies for early stage venture capital are innovation based. And basically what that means is they're developing a new technology. They may be developing a new drug, biotech drug, or a medical device, but something innovation based is driving the reason for the company. And these companies usually aren't lifestyle companies. These companies are started with an exit in mind, meaning either these companies are going to go public or later on they may be sold. Okay, so that's a little bit about the company characteristics. So what does an investment look like? Well, in early stage venture capital, the investment is going to be for usually a fairly small piece of the company in the early stages. So an early stage investment, an investor may come in, a venture capital firm may come in and want between 10 and 20% of the company in initial investment. So it's a minority investment. There is not control. It's not a controlled transaction. And these investments are just really cash going into the company. These are generally not financed with debt. The reason to make the investment is because these startup companies, you really believe that this has a massive potential for a significant return. But in exchange for that, you are assuming a very high risk of loss, and we'll talk about that in a few slides. These investments, if you make an investment in one of these companies, it's a private company. It's subject to a lot of contractual restrictions. And because of that, these investments are very illiquid. And beyond that, to really realize the potential of this investment, you may need to hold this investment for a very long period of time. And you can see here that the NVCA has, in a study, determined that the average holding period is about 8 years. Okay, so this slide basically shows some of the better known venture capital backed companies. These companies all took venture capital, some at very early stages. And with that capital, they have been able to develop their business models. A number of these companies have gone public and a few have been acquired by large strategics. Okay, so who are these venture capital firms? So here I've just listed some of the more active venture capital firms. And if you want, by using the raise your hand function, the little hand on your control panel, why don't you just let me know how many of you are familiar with one or more of these funds? Yeah, great. Okay, so a few of you do know these funds. Great. By the way, I have in a footnote here, in 2018, NVCA found that there are over 1,000 venture capital firms in the country. So there's a lot of firms out there. All right, now that we've kind of talked about venture capital, let's look at buyouts and see how they are different. Using the same construct as before, let's take a look at these companies. So the companies are usually fairly large companies to begin with. They're fairly mature. They tend to have pretty healthy revenues and are usually somewhere right around cash flow break even or positive cash flow. That's important because leverage is used in these transactions, and the company will need to pay down this leverage through its cash flow. The companies are usually, the reason why they're targeted is because they're operating inefficiently, they may be undervalued, or the buyout firm may see potential in the company that isn't being recognized by the market. These companies are most usually private, so they're privately held companies, but they can also be public companies that a buyout firm will acquire and take private. So let's take a look at the investment characteristics. So in these transactions, the buyout fund will acquire control. Usually that's 100% of the company, but it might be 90% or 80% depending on how the transaction is structured. As mentioned before, leverage is used, and leverage debt is used to help finance the transaction, and it's usually a fairly significant portion of that transaction price. The buyout firm, once it acquires control of a company, the way that it adds value, the way it creates value on its investment is it usually goes in and makes operational improvements. And so what is that? Well, that can be filling out the management team. That could be augmenting or growing a sales and marketing function. It could also be through finding other companies in the space that are attractive add-on acquisitions. So there are many ways that buyout firms will work to improve the performance of the company after it's made its acquisition. Like venture, these are illiquid investments, and like venture, they also have long holding periods, although compared to early stage venture capital, the holding periods are typically a little bit less. So here's some examples of companies that have been in buyouts, and just by looking at the names, you can see that it's a broader range of companies in differing industries. These tend to be well-known names that have been around for a long time. So it's very different than, say, early stage venture capital. And here are some of the better known private equity firms. And again, just to help me understand, if you could use your raise hand function to let me know if you know of any of these firms. And yeah, okay, several of you do, so great. Thank you for that. And let's just kind of take a step just to compare venture capital and buyouts. And so you can see here, early stage venture capital, there's no control, there's no leverage, whereas in buyouts, it's usually controlled transaction and debt is used in connection with that transaction. Early stage venture capital, these are startup companies. Buyouts are going to be mature. Early stage venture capital, little to no revenues, whereas in buyouts, they're going to be large revenues and usually cash flow break even or positive cash flow. And then finally, innovation is really up front and center in early stage venture capital, where it may not be the primary motivation for that investment in a buyout. Okay, so why invest in private equity? And to get started, I have a poll here for you. We actually have two polls. And so first question is, what annual returns do you think you should expect from investing in private equity? Here 5 to 9%, 10 to 14%, 15 to 20%, 20 to 25%, 25% and over. So if you could please make your selection and hit submit, and we will come up with the answers. So why don't we go ahead and close that poll, and see what people find here. So 10 to 15% is kind of the bulk. Some is let's see, 20 to 25 actually says 50%. So that's pretty interesting. So the range here is from 10 to basically 25% for what people expect. So that's a pretty broad range. Let's move to the second poll question. And this one just relates to what premium do you think investing in private equity should provide over an investment in, say, an index like S&P 500. So we're looking here for what kind of premium should you expect from investing in private equity over the public markets. So under 1, between 1 and 3, 3 and 5, 5 to 7, or over 7. So we'll wait another second, but why don't we go ahead and close that poll and see what the results here is. So interesting. So between 5 and 7 and over 7 are the answers here. So let's move forward on the slides, and we'll talk about that. So the main reason to invest in private equity is so you can get strong returns and outsized returns compared to public equity markets. And so what I have here on the right, this chart shows the 10-year returns for private equity as compared to the S&P 500. And usually what investors in private equity expect from a program, and it really depends on the construct of the program, but it really is somewhere between that 12 and 18% return, what people expect. Some people, if they are invested heavily into venture capital, they will expect a higher return, but for that you assume higher risk. But one thing I want to mention here is this. So what this chart shows for private equity, the number is actually 14.3% kind of average returns over 10 years. And then for the S&P 500, it's 13.1%. Most investors, when they invest in private equity, are looking for a premium over the public markets of somewhere between 2% and 7%. With most investors looking for a 3% to 5% premium over the public markets. So looking at this chart, you say, well, Alan, the private equity really doesn't hit that 200 on up basis point alpha over the S&P 500, and the answer is you're right. And the point here to make is what's really important about investing in private equity is manager selection. You want to be investing, you want to identify and invest in the best performing managers here. So really the top 25% of investors is what people target, and those are called top quartile managers. When you invest in those managers, you really do realize the greater returns and that premium over public markets that you expect to have. But there are other reasons to invest in private equity. Another reason is that when you add private equity to an investment portfolio, private equity actually has fairly low correlation to public markets, but it has very low correlation to the bond markets. And so by adding private equity to an investment portfolio, it actually improves the risk return profile for that portfolio. And then finally, just to note, the reason why I use 10-year returns is because private equity is truly a long-term investment. And for those new to investing in private equity, you really must have a long-term view when you create your program. And you really have to have a long-term horizon. All right, another reason to invest in private equity relates to the fact that in the US, there are only about 4,300 listed publicly traded companies in the US. If you compare that to, there are almost 2.3 million private companies in the US that have over 20 employees. So if you just look at the scope of the investment opportunity, The public markets are very heavily covered. They're very efficient, whereas in the private markets, they're less efficient, and the opportunity is just much, much greater. So that's another reason for considering adding private equity to your portfolio. So now that we've, the one last thing I want to mention though is risk. And what this chart tries to show is it tries to show the return and risk profile for a variety of assets. And here at the bottom, we expect cash to have basically no return, but really there's no risk for owning cash. As you move up, you can see US publicly traded stocks. You expect a better return, but you also expect greater risk. And venture capital and private equity have the potential to provide significant returns, but you're also moving way out on that risk scale. Okay, now that we've talked about why to invest in private equity, the next question is how much should you invest in private equity? And the answer to that is it's different for everybody. And what I tell people is your allocation could be anywhere from 0 to over 30%. So as an example, the largest sovereign wealth fund in the world has no allocation to private equity, whereas Yale University, who is a pioneer in investing in private equity, they have an allocation of over 30%. So it really varies depending upon the individual circumstances of each investor. For family offices, a study that was done in 2016 showed that 62% of the family offices at that time were investing in private equity. I believe that's gone up. And a more recent study indicated that the average allocation for the family offices was about 17%. So again, every investor is unique. You really need to consider the short-term, medium-term, long-term cash flow requirements of that investor. You need to consider tax status, and you really need to consider the risk appetite. Because private equity investments are more risky, an investor really must make sure that they have the appetite to invest in private equity. Okay, now that we've talked about why invest, let's talk about how to invest. And there are several different strategies. For this presentation today, we're going to focus on direct investing, fund investing, and fund of funds investing. But there are other ways also to access the private equity asset class. So diving into direct investing, and you can see on this diagram, it's pretty straightforward. The investor invests directly into a privately held company. This is a very risky type of investing, but it has the potential for really dramatic returns. If an investor is investing at the very early stages of a company's development, so early stage venture capital, there are very high loss rates. There's a rule of thumb in the industry for early stage venture investing that a third of investments will fail. Another third will fail to return capital, and then a third of the investments are actually going to drive the returns. The reason why that's important is it demonstrates the importance here. If you are going to invest directly into companies, you really need to have a well-diversified portfolio, and you have to have several investments. Some studies show that should be in excess of 20. There are some studies that actually have that at a higher number. So you really need to be thinking, if you're going to be a direct investor, you need to be thinking about having a portfolio of investments. Another type of direct investing is co-investment. And co-investment occurs when an investor is already an investor in a private equity fund, and that fund manager offers the investor an opportunity to invest alongside the fund into a company. The reason why co-invest is attractive is because if you've invested in the manager, you've already vetted that manager and you have confidence in their strategy and their investing abilities. And so you can rely to some degree on their analysis and due diligence on an investment before you make that investment. So co-investment is a very popular strategy as well. This slide is from some academic research that was done in 2004. And what this really shows, it's a risk profile. And so here on the bottom, this shows what the potential return is. So a 0 means you've lost all your money. Here, a 1 means it's 1x return and you've received your money back. Over here, this shows that you receive over 10x of your investment back. And so what this slide really shows is it echoes that rule of thumb that we talked about in the prior slide. And this academic research shows that there's a 30% probability of early stage investing of losing your entire investment. But if you're investing in early stage private equity, you also have, in this case, it's a little over 10%, probability of having a home run, a 10x plus home run. But again, you really need to consider that direct investing is a very risky type of investment. This slide just kind of highlights a few of the many considerations when making direct investing. There are lots of risks, there are lots of considerations to make as you develop your direct investing program, and you should really work closely with either an external advisor or if you have the in-house capabilities to really make sure that those considerations and risks are fully understood. All right, let's talk about fund investing. For fund investing, as the diagram shows, the investor is investing in a fund or a portfolio of funds, and those funds will invest in a portfolio of companies. A couple notes about these types of investment. When you invest in a fund, it's a passive investment. Unlike investing in a publicly traded stock, there really is no board of directors. When you think about funds, the fund manager really has total discretion over the investments and operations of the fund. So when you are making a fund investment, you really want to be comfortable with that manager, with their ability to manage a fund, ability to manage their firm, and the ability to make investments that are going to have very strong returns. A couple things about these. Private equity fund investments are blind pools. So what does that mean? It means that the companies that the fund is going to invest in aren't known. When you make the investment, you know the strategy that the fund manager is going to take, is going to use, but you have to rely on them to identify, to source the companies, and to make those investments. So that's why it's known as a blind pool, because the fund, when it starts, has 0 investments. You don't know what they're going to be, and the fund manager will identify attractive investments over time. If you are making a fund program, where if your private equity program is going to be primarily based on funds, you also want to have diversification across different funds. You want to have different managers, you want to have different strategies, sectors, stages, geographies, and you also will want to invest across what are known as vintage years. That's the year, generally speaking, of the fund formation. So as a fund investor, you're still going to want to invest in multiple funds to obtain some diversification. I just want to talk a little bit about how it works. So funds are on a committed capital basis. So this is very different from a mutual fund. In a mutual fund, you write a check, they deploy it. When you want your money back, you just let them know when you get your money back. This is different. This is where an investor will make an initial commitment of a certain amount of dollars that they're going to invest in the fund. Let's say it's $1 million. The fund doesn't need that money right away because, as we discussed earlier, it has to identify the companies that it's going to invest in, and it's going to then, over time, over a span of several years, make those investments. So because it doesn't really know when it's going to make those investments, it doesn't need all of that cash up front. Instead, the fund manager will call capital when it needs it. And the timing of those, as we said, is uncertain. What this chart here shows, this red that's below the line, these show cash outflows from an LP. So this is really from an investor perspective, an investor in a fund. And initially, you are going to be giving the fund money as they make capital calls. And this usually occurs mainly during what is known as the investment period. It's usually a 5-year period when they're identifying and investing in new companies. And then after those investments begin to mature, they will exit those investments. And as they exit the investments, they will give money back to the investors, which are known as distributions. So when you combine those, you can see how this kind of works, that over the first several years of fund life, you are going to be, as an investor, you're going to have net outflows to the fund. But later in the fund's life, when you hit the realization stage, you will then move into the positive net cash flow arena. One question that I often get is, Alan, why are funds both calling capital and returning capital as a distribution in the same year? Why don't they just, take less capital and not have to return it? And it has to do with the uncertainty of the timing of when they're going to exit an investment. But there's also another reason, and it has to do with how a fund's returns are measured. Funds are usually measured on a rate of return, an IRR basis. And if a fund has cash sitting on its balance sheet, that cash is basically earning zero, and it's going to hurt the returns for the fund. So funds don't want to keep excess cash on their balance sheet. And so that's really how this works. So in the early years of the fund, there are going to be LPs are going to be having cash outflows. And then in the later years of a fund life, as the fund exits its investment, it'll return capital to the investors. Okay. So the next thing is, how do private equity pros get paid? Well, it's primarily through a management fee and a profit share. Generally speaking, the management fee is around 2%, but there is a range, and it depends on the fund strategy and the fund size. And then typically after that 5-year investment period, the management fee tends to step down over time because the hard work is really done. They've already made their initial investments in the companies. And usually if the fund is successful, they'll have raised a follow-on vehicle, and so they'll be getting some management fee from that other vehicle. So you typically see a step down after the investment period in that management fee. But the way that fund managers really make money is known as carried interest or carry. It's really the profit share. And most fund managers get 20% of the profits. And so in the buyouts and for growth equity funds, that's typically paid after the investors receive a preferred return, which is usually around 8%. So for buyouts and growth, after there's an 8% preferred return received by the investors, then the fund manager will take its share of the profits. And really the final thing I want to mention here is something known as the J curve. So we've talked about how the cash flows work, but here I want to mention that early on in the stage in the fund's life, as it's making investments, those investments take some time to grow in value. And in the early stages of a fund life, the fund will have organizational expenses that it has to pay. It'll have management fees and fund expenses. And then, usually in early stage venture, there may be some early investment losses. As we talked about early stage venture, a third of these companies are expected to fail. And so what that means is that early in the fund's life, as you think about the returns, in the fund's life, the value of your investment is going to decline in the first few years of a life. And then as the company's investments increase in value over time, then you will begin to see an appreciation in value of your investment. So understanding the J curve is very important. So what it means for new investors is as you invest in funds, you need to be ready and expect that your $1 million investment or your carrying value is actually going to go down initially, but then it'll go up over time. Okay, here's a risk profile of a fund investment. This is similar to the prior slide. If you remember in the prior slide, a direct investing had a 30% probability of total failure, but it also had a over 10% probability of getting a 10x plus return. In a fund investment, it changes because a fund will be investing in a portfolio of companies, and so the fund itself will have diversification among those companies. As a result, the probability of losing all of your money is very low, but as an investor, the return for the exchange for that is that you lose the probability of having massive 10x returns for a fund, although if you do achieve that. And then finally, there are lots of considerations for investing in funds. We've talked about a few of them. A couple other things are there's a lack of transparency. So often in funds, you will get some information about the underlying portfolio companies, but you're not going to get an overwhelming amount. Another consideration is that there is a reporting lag, meaning that most private equity funds only report on a quarterly basis, and that usually those reports are issued 45 days or 60 days after the end of the quarter. So the information you're getting about the fund is already a little bit dated by the time you get it. So there are lots, as we talked about for direct investing, there are lots of risks, there are lots of considerations, and you should work with your external advisor or your team internally to really make sure that you understand those considerations and risks. Okay, finally, we want to talk a little bit about fund of funds. And fund of funds, I think, have some real benefits to investors in the private equity asset class, and I think they could be good for the right investor. The way fund of funds work is an investor makes a commitment to a fund of funds. That fund of funds makes commitments to a range of portfolio funds. Usually you see 10 to 20, sometimes more portfolio funds, and those portfolio funds invest in companies. So as a result of making one investment, an investor will obtain exposure, indirect exposure, to a portfolio of funds, say between 10 and 20 or more funds. And then they will also have indirect exposure to a portfolio of companies. And these can be, hundreds of companies in the underlying portfolio that the investor is getting indirect exposure to by investing in a fund of funds. So you get great diversification here. You get fund manager diversification, and you get underlying company diversification. Most of the fund of funds are also blind pools, and which means that when you make the investment in a fund of funds, the managers in which the fund of funds will invest are not known, and they will identify the managers and invest in the managers over their investment period. Having said that, a number of fund of funds will have target lists where they have long-standing relationships with hard-to-access managers, and so they may identify the managers that they are targeting for investment in the fund of funds. You see that often in venture capital strategies. Okay, so what are the benefits of fund of funds? Well, they're really, to me, a benefit for investors in a few ways. One, if you have a smaller program, a fund of funds can be a good way to really develop your program, because you're making one investment in a fund, but you're getting exposure to many underlying portfolio funds and many underlying portfolio companies. It's also a very effective way to obtain exposure to a specific strategy, such as venture capital, or a geographic type of fund, such as a Latin America type of fund. Those specialist funds, those managers will have great experience and skills in those areas, and so it's a great way to access those specialized strategies with a single investment. One of the knocks on fund of funds is the issue of fees on fees, because the fund of funds is going to charge a management fee and it's going to take a carry. Now, the management fees for fund of funds are usually much less than a fund. I say here 1% or less. 70 basis points for a management fee is something you see very commonly, and then a carry of 5%. So the fund of funds does charge a fee and carry, but it's much less than what a fund manager will charge. Okay, so let's talk about the risk profile for a fund of funds. So as we talked about, direct investing, 30% probability of nothing. But in a fund investing, that probability went close to zero probability for a complete loss at the fund level. For a fund of funds, as you can see here, the probability of any loss is actually fairly low. But the trade-off is that the potential for big returns also goes away. So again, because of the diversification built into a fund of funds, you will see kind of this type of a profile for them. It's a great way to get exposure, and it's also a good way to minimize some of the potential losses. But in exchange for that, you also expect lower returns. And that's really, that's most of the presentation. The takeaways here, investing in private equity, it can be a great way to obtain outperformance when compared to other asset classes. But as an investor new to private equity, you have to really understand the risks, and you have to be willing to accept those risks. And so because of that, private equity may not be for everyone. And the bottom line here is, to have a successful private equity program, you really need to be working with somebody that's experienced, either in-house or an external advisor. You want to have somebody that is experienced in the strategies that you're interested in. And by investing in top quartile managers, the best performing managers, you can really achieve, you have a much better potential of achieving those outsized returns we talked about before, where you're getting, a 500 basis point to 700 basis point outperformance over public markets. And with that, I think we can move to questions and answers.
All right, thank you, Alan. We're now going to begin answering the questions submitted during today's presentation. As a reminder, you can submit questions through the questions pane of your attendee control panel. Back over to you, Alan.
Thank you. Okay, just for fun, I'm going to turn back on the webcam, and let's dive into some questions. Okay, so I see we have a few here. The first one is, what are secondaries? Can you describe secondaries? So I didn't really focus on secondaries because I was a little concerned about time, and I wanted to have time for Q&A, but it's a great question. And what secondaries are, there are really two types of secondaries. And one is called a fund secondary, and the other one is called a direct secondary. A fund secondary is where an existing investor in a fund sells its interest in that fund to a buyer. And the way it typically works, there isn't really a public market for this. So these are private transactions that occur. And usually because the investor in the private equity fund has signed what's known as a limited partnership agreement, there are restrictions on their ability to transfer that. So you have to work with the fund to manage that sale. And usually what happens is if you are carrying, if the investor is carrying their investment at, say, let's just call it $1 million, a buyer will make an offer for that. And that offer will usually be at a discount to what the investor is carrying it at. But in some cases, it actually may be at par or it may be at a premium. It really depends on the interest that's being acquired. So a secondary transaction is when a buyer buys an interest in an existing fund from the investor in that fund. There are many funds that have been created to do secondary transactions. And so these secondary funds, as they're known, can be actually a great way to complement a program, and it can actually be used to help minimize the J curve that we talked about before. So that's fund secondaries. Direct secondaries is where a buyer buys an interest in a company that's being sold by a shareholder in that company. Again, these are private transactions. There are contractual restrictions that have to be worked out, and then often these transactions are done at a discount to the carrying value of the interest that the seller has. So there are fund secondaries and there are direct secondaries. There are also many funds that specialize in doing these direct to secondary transactions, and those funds can also be a really good way to add diversification to a portfolio, but also to minimize that J curve. Let's see what other questions here. So another question is, what are your thoughts on the SoftBank Vision Fund? Yeah, it's a great question. So for those who may not know, SoftBank raised a fund in, I think it was 2017, of roughly $100 billion. And it has invested that money in a broad range of privately held companies. I think they were an investor in WeWork as well as in Uber. And the impact here is because it's such a massive fund, they are writing very, very large checks to these private companies. So the impact of that is if you are a company that is in a competitive sector and you're one of, say, 6 companies that are addressing that sector, and one of those companies gets $1 billion investment from SoftBank, it's a game changer. And you, as one of those other 5 companies, you're either going to have to try to compete with them, or you're going to have to raise money to be able to compete with them, or you're going to have to find some way to get some type of a strategic partner, or sell the company either to the company that got the SoftBank investment or to another strategic. So I view SoftBank as really, in many ways, as a game changer, and it really shows that capital can be a huge competitive advantage for those people that are getting those huge checks from the SoftBank fund. SoftBank actually just announced, I think last week, that they are raising a SoftBank Vision Fund 2, and that they've already received commitments of 108 billion for that fund and expect to have more. So there's going to be a SoftBank 2 fund, SoftBank Vision Fund 2, and it's going to continue making these huge bets on these private companies. Another question here is, are we in a bubble? That's an interesting question. And the answer is, I just don't know. I have lived through the 99-2000 internet bubble. I lived through the 2007, 2008 financial crisis. There's a lot of what's going on today that to me feels like it did in the run-ups to those big events. So I think right now we're seeing very high valuations in both venture and buyouts. We're seeing a massive amount of capital coming into private equity and venture capital. But whenever I try to predict when the market is going to turn, I'm always wrong. So suffice it to say that I think we are kind of in the later part of an economic cycle, and I think we're in a later part of a cycle for private equity as well. Okay, another question. Here's one. How are private equity firms structured? So this is a question that I actually had a slide for, but I took it out in the interest of time. In the US, these funds are typically structured as limited partnerships. And limited partnerships are fairly unique in that there are two types of partners. There are limited partners who are typically the investors in a fund. They are also known as LPs. And investors in limited partnerships by law are passive investors. The second type of partner in the fund is known as a general partner. And the general partner has the management. They manage the fund and they have pretty much full control over the fund's strategy, operation, and investments. So the manager is known, it's called a general partner or a GP in that limited partnership. So as new investors come into private equity, something that I think is very important for an investor to really understand are to understand the contract terms of those limited partnership agreements. And again, for that one, you can either rely on an experienced lawyer or you can work with your external advisor to really understand what the key provisions are of those limited partnership agreements. So hopefully that answers that question. Let me check some other questions. What is a unicorn? Okay. So what a unicorn is, it's a term that actually started just a few years ago. And it really is meant to describe a private company that has achieved a 1 billion plus valuation through one of its financing rounds. And today there are, a few years ago, there were only a handful. Today there are, well over 100 unicorns. And it's actually, there's a new term now, I think it's called a decacorn, which means a company that has achieved a $10 billion valuation. So expect other corns to crop up as valuations rise. Okay, here's a question. Let's see, what is growth equity? So we didn't talk about growth equity. What growth equity does is it really sits, if you will, between venture and buyouts. And it can mean, the term growth can mean different things to different people. I'm going to define growth equity as follows. I think growth equity should be where it's the first institutional money invested into a company. These companies typically are a little more mature. They typically have fairly well-established revenues. They may or may not have positive cash flows. And so these growth equity investors, they scour the United States for these types of companies that they believe could really use some capital and expertise to help these companies really grow and achieve their potential. So when a growth equity fund makes an investment in a fund, it is usually a non-control investment. So similar to venture in that it's a non-control, but it's usually a significant portion. They will almost always take one or two seats on the board of directors, and then they will work with that company to implement that capital, and that can be to build out a sales team, either for R&D or possibly for acquisitions. But in addition to it being a minority investment, it's usually an equity investment. There's usually not leverage involved in that transaction. So from that perspective, it looks really more like a venture style of investment as opposed to a buyout. But the reason why it kind of sits in between is because these companies are generally much larger companies than, say, early stage venture. They have, meaningful revenues. There's really no product risk because their product is proven. There's really no market risk because the market is proven. So it's a different risk profile than, say, early stage venture. Okay, here's a question. What are my thoughts on hedge funds entering into venture capital? So it's a good question. And just a little bit of history. Back in the 99 bubble and also in the 2000, 2007, 2008 bubble, we saw a lot of kind of more public company investors, hedge funds, mutual funds, starting to invest in late stage venture capital because they wanted to take advantage of the potential returns there. So these public market investors, hedge funds and mutual funds, public market investing is very different than venture investing. And so when hedge funds come into the venture arena, it can work if they have the expertise. So usually a hedge fund may bring somebody in that has that expertise or they already have it. And they will also be making much later stage investments in these companies. So where the company is in their cycle is kind of in a pre-IPO stage. So hedge funds investing in venture capital deals can work if the hedge fund really has some expertise and really understands the long-term nature of these investments. Sometimes I've seen hedge funds get into private equity and not truly understand the unique characteristics and considerations of private equity investing, and it just can create problems. Okay, and with that, I see we have a few more questions, but I want to make sure that we end on time. So I'm going to turn it back over to Lori, and we'll wrap this up.
All right, thank you, Alan, and thank you everyone for attending today's webinar. Once you leave today's webinar, you will receive a survey on the presentation, and we would appreciate it if you would complete that and provide your feedback. You'll also receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. Any questions not addressed during today's webinar will be answered via email. On behalf of Campton Private Equity Advisors, thank you for joining us today and have a great rest of your day.